Bismillahir Rahmanir Rahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalam ala Sayyidina wa Nabiyyina Muhammad wa ala alihi wa sahbihi ajmain. Distinguished guests, ladies and gentlemen, Assalamu alaikum and good morning. It gives me great pleasure to welcome you to our investment webinar entitled Investing in the Age of Magic Money, brought to you by Emirates Islamic in collaboration with Refinitiv, now a London Stock Exchange Group company. My name is Mustafa Adil. I am the head of Islamic finance at Refinitiv, now LSEG, and I will be your MC for the webinar today. As I'm sure you're all aware, 2020 was an extremely challenging year for everybody, with the COVID pandemic bringing about the worst health crisis in living memory, 1 million deaths, and over 115 million infections. As always, our thoughts and prayers first and foremost go out to those who have lost loved ones to the illness, who are fighting to keep us all safe. This health emergency very quickly evolved into a full economic crisis, with significant declines in global output, productivity, trade, and a significant collapse in financial markets towards the start of 2020. Now, while some sectors fared better than others, it's very safe to say that no to this impact. As governments tried to provide economic relief through various monetary and fiscal policy packages, we entered into what some have coined the age of magic money. Today, central banks are offering funds at record low interest rates, and this is expected to remain unchanged in the medium term. This is being felt across financial markets, where we are seeing unprecedented volatility, even in traditional investment asset classes such as equity and fixed income. So how can investors navigate through these uncertain and turbulent times while still taking advantage of the opportunities that are there in the market? Well, to tackle some of these questions, we are extremely privileged to have a distinguished panel of speakers from the investment and research teams at Emirates NBD, who will be providing us who will be addressing many of these questions here today. They will be providing us insights and an overview of the investment landscape and across financial markets. We will be having a deeper dive into investment strategies that would be appropriate for asset classes such as equity and fixed income. And finally, they will be highlighting some of the key and regional economic trends that we need to be mindful of in 2021. So as you can see, we have a packed schedule today. So without further ado, let's get started. And it gives me great pleasure to welcome Mr. Wasim Saifi, the Deputy CEO, Consumer Banking and Wealth Management at Emirates Islamic, to deliver his welcome remarks for the webinar today. Wasim, the floor is yours.
Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullahi wa barakatuhu. Thank you so much, everyone, for making it a point to attend today's what we consider to be a very interesting and thoughtful webinar. As Mustafa talked about, the topic is really investing in the age of magic money, and as you will see through the presentations, some very interesting thoughts coming out of it. We went through a very challenging year in 2020, probably one which most of us would not have seen in our lifetimes. From things like lockdowns, business closures, job losses, these were all part of the year itself. And it followed by numerous government actions in different parts of the world, fiscal measures, monetary measures to try and ease some of the economic fallout arising from the COVID pandemic. Here in UAE, we were also very, in fact, extremely privileged to have a very proactive government and a very proactive central bank, which took strong measures to help the affected parts of the community deal with the challenges of the pandemic, be it things like liquidity measures, pumping enough liquidity into the banking system so that the flow of credit would continue. Deferments and other relief measures to help those affected, either by their businesses being affected or by their job losses or by their leave without pay situations that many employees were faced with. And Emirates Islamic and Emirates NBD Group played a very important role, being among the leading banks in the country, to try and help its customers through this very difficult period. Now, since then, we've seen some element of comeback, though obviously a lot of challenges still remain and a lot of businesses still struggle. But in some sense, we are seeing some of the segments come back and at least begin the recovery process. Thankfully, alhamdulillah, with vaccination having accelerated so strongly and so substantially, we are all looking forward to the next few months really taking care of the other challenges posed by the pandemic, and hopefully thereafter we can see the economy move back into the pace that it was already there in prior to the pandemic hitting us. Now, through all this period, of course, the financial markets behaved quite differently. So there was a real divergent behavior between the real economy and obviously the financial economy, equity markets, fixed income markets, in many parts even real estate and other alternative investment forms did pretty well, led largely because of a huge amount of liquidity coming into the system, largely because of rise in household savings in many parts of the world, with absence of spending opportunities, and so we saw the markets really move quite differently. Now the stage where we are, we've really got the real economy, and then you've got the financial economy, and it'll be interesting to see at what stage they start converging, and at what stage we really start seeing things move, the markets move in tandem. Yeah? And that's something that we'll find interesting to look at as Maurice and his team take us through what their outlook is on the investment side. Thank you once again to all of you for taking the time to be present in this event, and please ask as many questions as you can to try and get as much as you can from the webinar. Thank you so much. Back to you, Mustafa.
Thank you very much, Wasim. And I completely echo your point. We were extremely fortunate in the UAE to have the government take such a proactive role, both in providing economic support to the individuals and businesses that needed it, but also with the vaccine rollout, which is regarded as one of the best or most well-coordinated in the world. And I think you really hit the nail on the head. What we saw last year was a complete divergence in behavior between the real economy and financial markets. And hopefully Maurice and his team will be able to shed some light for investors on how they can, better understand and better manage their savings and their wealth in this climate. Thank you so much, Wasim. And ladies and gentlemen, before we start the webinar, I think it's very important that I go over some of the basic ground rules to help you better connect and better engage with us during the course of these sessions. So first and foremost, I would like to mention that if you have any technical issues during the webinar, you can always click on the help widget that should be located near the bottom of your screen, and you should be able to reach out to one of our organizers who would be able to help address any technical issues that you may face. If you have any questions for the speakers, please click the Q&A widget. We want this session to be interactive. We want to engage and address your questions. So please do ask your questions. We have dedicated Q&A session towards the end of the webinar where I will be posting your questions to the speakers. So if you want to address anything, if you want to have any of your points of views tackled by the speakers, then please do highlight the widget as well. To access the speaker's presentation, if you cannot see it, you simply need to click on the presentation widget and you'll be able to see they are presenting. And during the course of the session, we will be asking many poll questions because we want to get an understanding of your perception of the market and your assessment. So we will be raising various poll questions throughout the sessions. So please do click on the answer that you feel best reflects your opinion to the question that is being asked. And as always, we will be sharing a recording of the session so that if you miss any part of it, you can always go back and rewatch that. The link will be shared to all delegates after the webinar is concluded so that you can, if you want to reflect back on something, you can always go through the recording and do that as we go. So without further ado, we will start the first session, which will focus on the overall investment outlook and financial markets. This will be delivered by Mr. Maurice Gravier, who is the Chief Investment Officer for Emirates NBD Group. But before I hand it over to Maurice, I think I want to engage the delegates now with our first poll question of the day. And that poll question is regarding the expectation of the virus, right? And the question is, with regards to the virus and the economy, do you start 2021 with optimism that we will defeat COVID and come out even stronger than before, with pessimism that the virus is here to stay and the consequences are here for the long term, or with a sense of pragmatism that the most important thing is to adopt no matter what happens? And, obviously we all ready for that adoption, but it's very important to see what the investor outlook is and what people are feeling. Is it a sense of optimism? Is it a sense of pessimism? Or is it pragmatism to just simply adopt whatever situation comes through? So please do select the answer that you think best reflects your expectation. I know for myself, I have days when I'm optimistic, I have days when I'm pessimistic, and then most days, unfortunately, are plain confusion. So it's very difficult to address, but whatever you feel is the most effective, please select that. And I think if we've gotten enough responses, we can move to the answer. And very, very interesting. 54% of you pragmatic. I think that drilled a sense of pragmatism into all of us, and I'm not surprised to see that. But what is very encouraging is 41% optimistic, right? That we will defeat COVID, we will come out of this stronger than before, and only 4% of pessimism. So I think very, very strong optimism there, along with pragmatists that are there. So I think that makes for a very, very interesting reading. I was hoping for this result, but I didn't expect it to be as, broad between optimism and pessimism as we see. But I think that's very, very encouraging. And I think that's food for thought for you, Maurice, as you talk about the investment outlooks. So over to you.
Definitely. Thank you very much, Mustafa, and thank you very much, Wasim. And yes, that's a fantastic result. I like that because I think that one of the big positive lessons from the crisis we are living is our ability to adapt to anything individually, collectively. And yes, the UAE was certainly the best place to be in the world during this crisis. Anyway, welcome to our Global Investment Outlook. We are delighted to have you. It is virtual, but I'm sure that we will meet in person next year, I hope. And whatever the format anyway, it is a privilege and an honor to have your time and your attention. I will start with a quick recap of 2020, what we said, what happened before going into the big picture for asset allocation. Our key messages are simple. First, we have a reasonably constructive outlook for 2021. But second, for the long run, the consequences of what we call magic money, and we'll come back to that, require adaptation over the long run. And on both horizons, our answers are more emerging markets and more selectivity. My colleagues Anita and Satya will detail selectivity within equity and fixed income before our chief economist Khatija gives us a wide outlook of the economy for the region in a global context. So before that, let me start as always with what we said last year. Last year, we had three messages. The COVID was just starting. We expected positive performances, 4 to 6%. Second, we highlighted flexibility because we were expecting a lot of volatility. And third, already we liked emerging markets a lot. That was our messages at the beginning of 2020 for 2020. And I must also say in full transparency that at this time, I thought that this new coronavirus coming from Wuhan, China was going to be mostly a problem for Asia and mostly for Q1. I was not over concerned, and frankly, I was so wrong. So the dual shock that Wassim and Mustafa were referring to in 2020, we know the story, the global pandemic and the global recession, two being extremely brutal and of historic magnitude. The good news, however, is that the responses were also massive and of historic magnitude. Economic responses first. Governments spent trillions, literally trillions, to support income. People were losing jobs and to protect the economy, to avoid economic devastation. To fund this, to make money available in quantity and at a very low cost, central banks around the world just put interest rates at zero and created money to make it available. It's massive liquidity injections, this ocean of liquidity. We'll come back to this duality between fiscal policy, budget spending, and monetary policy, printing money and interest rates, because that's very important. So massive economic response. And on the healthcare front, an amazing success. The vaccine have been made available in less than a year. So we've had a dual shock and a dual response. No surprise then that markets made a V-shaped pattern, very impressive, a crash, everything in March, followed by a rally, which only accelerated at the end of the year in Q4, more fiscal support, and more importantly, when the vaccines became available. So what happened to our three messages? I would highlight the second one, flexibility. We changed our mind. We were wrong on the severity of the virus, but fortunately, we changed our mind just maybe 1 or 2 weeks after having done our global investment outlook, and we made our largest risk reduction ever. You can see the chart maybe on the right. We sold stocks massively, our biggest ever in February, with profits at this time because markets were up before the virus has hit the shores of America. That's how markets work. Then we changed our scenario, of course, to integrate what was going on. We reviewed our fair values. You know that we work with fair values on key asset classes, and my colleagues will share their fair values for 2021, of course. And we came to the conclusion after the crash that it was time to buy back. So we sold in February aggressively. We bought back everything 30% lower in March, and we remain invested all the rest of the year because we saw that people were too defensively positioned, not ready for good news. That was our key asset allocation move of 2020. So as you rightly said, there is an apparent disconnection because the year was terrible for the world, no doubt, but it was very good for financial assets, led by gold up 25%, and it was our preferred defensive asset, followed by emerging market stocks up 18%, which was our preferred cyclical asset. So what about our 4 to 6% expected return? It was wrong as well. We did much better. Our three profiles delivered 11, 12, and 13. And it was not just better than our own expectations. It happens, thanks God, that it was much better than our international competition because people were too defensively positioned, and actually we were not. So that was for 2020. Now let's look at the future as a kind of a new day is rising on this ocean of liquidity, and we call this the age of magic money. So what is it? Let's start with the amount. Just to give you an idea, the chart on the left compares the total economic response to the COVID-19 crisis, that's the bars on the right, with the total economic response to the great financial crisis of 2008, 2009. You see, I don't have to comment anything. It's massive, it's a multiple, it just doesn't compare. So the question is, of course, where does this money come from? That's where is the magic. And the answer is simple. This money came from central banks. This money was created out of thin air by central banks. They created it, they lent it, by buying bonds, especially government bonds, sometimes corporate bonds, sometimes lending it directly, and more importantly, governments spent it. So you had money created by central banks, spent by governments to support the economy. This combination of fiscal and monetary working together is the implementation of something called modern monetary theory, MMT. That's what we call magic money time. This theory, and I'll spend a minute on that, is quite simple. It says that if a country can print its own currency, it will never default on its debt because, of course, you just have to create money to pay it back. So for the MMT supporters, public debt and public deficits are not a problem. It's the opposite. They are very good because the government can spend, support education, healthcare, infrastructure, and even fund new ideas like universal income or helicopter money, sending money to people. And that's more or less the theory. It sounds a bit too good to be true. So we looked at when did it happen in history. It happened once, and it's the bad example, 100 years ago in Germany. Germany had to repay the debts and the penalties from World War I. And they did that by printing money, Deutschmark. It was the Weimar Republic. The result was hyperinflation, misery, and ultimately a default, Hitler, and World War II. So it was not a good experience at all. More recently, in the great financial crisis, you remember that all central banks created a lot of money. Quantitative easing, QE 1, 2, 3, the Central Bank of Europe, whatever it takes, creating money. The difference is that this money remained in the financial system. It wasn't spent by governments because at the end, the levels of public deficits went back to normal. So it wasn't really MMT. It was just this money creation. Actually, there is only one live example of a country doing this for some time, and it is Japan. And let me have a look at it, because now that the world is in it, it's interesting to look at Japan. As a proportion of its economy, no other country in the world has borrowed as much money and created as much money as Japan. To put a number, back in 2000, the debt to GDP ratio of Japan hit 100%, the highest in the developed world. At this time, people were saying, okay, Japan is gone, they will go bankrupt. 10 years later, it was 200%, and now it's close to 250%. Did we have a debt crisis? No, not at all. If anything, interest rates that the Japanese government is paying, you see it's the dark line on the chart on the left, are going down. There is no debt crisis. Interest rates are lower, full employment, no inflation, magic. What is the reason? The reason is this orange bit that you can see. It is the balance sheet of the central bank, the Bank of Japan. Every month, with Japanese discipline, the Bank of Japan creates Japanese yen as much as needed to buy all the bonds that the government has to issue. So this looks a bit too good to be true, but it exists in Japan. The rest of the world was very skeptical, especially in Europe, I must say, and especially Germany, because of this example. But the pandemic lifted all taboos because there was no choice. People were losing their job, their income. You had the risk of a full devastation of bankrupts everywhere. So governments had to spend. It was the right thing to do, and central banks followed. So numbers are amazing. If you look at just the US public deficit should reach 20% of GDP, never ever seen before. And in Europe, according to McKinsey, the total size of what has been spent by governments is 30 times the current value of the Marshall Plan, which was to rebuild Europe after World War II. So the numbers are just absolutely stunning. Next question of this situation, now that magic money is everywhere in the developed world, how does it impact your investment? And there are two consequences on two distinct horizons. First, on the short to medium term, let's say 2021, it is a boost to the economy, because what is very different with a simple quantitative easing, where money used to stay in the financial system, this time it went to people. People everywhere received money to be spent or to support their life. In the US, that's the chart I have on the left side. The dark line is the US average personal income. And you can see that during the crisis, it didn't go down, it went up. That's the level, that's the magnitude of the fiscal support which was done. People saw their income higher during the crisis than before. So what have they done with that money? They have spent some of it. That's why the good sectors are not that bad. That's why e-commerce is absolutely thriving, and they have saved the most of it. That's the gray area that you see, the savings rate, which is much higher currently in the US than where it is on average. What does it mean for the future? First, as Wassim said, this savings, it was not always very quiet. Some people have speculated on Bitcoin, on some very hot stocks, but overall it was saved. It means that people have this ability to spend their money. As soon as the virus will be under control, we will see them spending, going out to restaurants, traveling, and we expect an uplift in the services sector, which is the missing part of the recovery. So we have a strong recovery ahead, and that's the first consequence. Second, there are consequences on the long term, and they are less good. Investments, it's about returns and risk. For the return, interest rates, by the way, I always talk about interest rates from a conventional background, but of course, our excellent colleagues at Emirates Islamic translate this into Sharia-compliant assets. So interest rates have disappeared. You have no source of return without risk, and equity valuations are elevated. It means that returns for the future will be lower. What about risks? Risks have not disappeared. You know, the usual risk that we always have, the business cycle, the geopolitics, you name it. But on top, you have new risk probably from this modern monetary theory. Inflation, if you print enormous quantities of money, at some point, prices should go up. What about the value of currencies themselves? They should debase if everyone is printing them. There are also zombie companies. If money is free, you have some companies that are kept afloat just because they don't pay a lot of money on their debt. They don't pay a high level of interest rates. With normal interest rate, they would go bankrupt. And in the meantime, how do you know if they are good companies if you are an investor? And if you are a competitor, you see your competitor, normally they should disappear. That's the law of economics, but they don't. So they take market share, they operate. There are this kind of disruption. And of course, the big question is, will it end? When? How? And what will happen when this extraordinary policy support will be removed? We don't have the answers, unfortunately, to these questions, but at least we have done our work. The first part of our work is to calculate these expected returns that we have looking forward. That's the table that you have on the left. And no doubt, we've done that with quantitative models that work very well on the long term. The returns, the performance that you can expect for the next 10 years are lower than history everywhere. In all asset classes, you can forget, again, it's conventional asset classes, but you can replace bonds by Sukuks and it worked. You can forget the kind of return that you had from risk-free assets before. We have done this, and then it's about reallocating in our strategic asset allocation to adapt to these long-term new things. That's just what we have done, and I will spend a minute on that. Strategic asset allocation, it is, what defines the three profiles. We talk with you, you are cautious, moderate, or aggressive. What does it mean to us? It means to us capital preservation at 3, 5, and 7 years. We do wealth management, all of us. We are not there to take outsized risk with your money. We say, if you are cautious, moderate, and aggressive, we will minimize the probability of loss over 3, 5, and 7 years and deliver you the best possible expected return. And now, for the next decade, given this context of magic money, where you can find the best expected returns under this capital preservation objective is in more emerging markets. So the first message for the long run is that there are more emerging markets in our long-term asset allocation than ever. And we hope that all our competitors, we do the math, because many of them, they haven't changed anything. They still have lots of, government bonds and US stocks in their allocation. Now, What about the year? Let's go back to this more medium-term view. Again, I have 3 messages for you. And you know what? You may think I am lazy, but our messages are quite close to what they were last year, actually. First message, we expect positive return because we have this boost to the economy. Yes, valuations are expensive, but overall, this boost should win. So we expect positive returns, but the year will not be as good as it was in 2020. And if I had to give a number, it would be around 4 to 5% for our 3 profiles. Second, we still expect volatility and probably even more than last year. I know it sounds surprising, but it could be more because some things have changed in sentiment and positioning. And third message, always emerging markets, they are not just good for the long run, they're also good for this year. So let me go through these 3 messages in a bit more detail. First, positive but moderate but positive returns for the year. To calculate the returns, we look at 3 things. What happens, the economy, what is priced in, the valuation, and finally, where are investors and where should the money go, which at the end of the day moves markets. So for the backdrop, there's no question. We have a strong recovery ahead. It is enabled by the vaccines, which start everything. It is kickstarted by this fiscal stimulus, the ongoing one plus the new one, especially in the US. And then it is kind of turbocharged by this very low interest rates environment, which favors, consumption and investment. The IMF expects global GDP growth to be plus 5.5% in real terms. I mean, without inflation, which is probably one of the best numbers in the last 30 years. We have this huge rebound. Good news. What about valuations? That's the bad news. The number I've put, 96%, it is the current percentile of the valuation of US stocks, which are 2/3 of the market cap of the world. It means that 96% of the time in history, valuations were cheaper than now. They were only like today or higher 4% of the time. We are at the top of the range, and it is a warning signal. The point is that we think that there are good reasons for valuations to remain elevated, and I'll come back to that in a second. Third thing, sentiment. It's also not a very good news. I'm sure you remember we had the pleasure to be with you in our mid-year update in July, and all of last year we were telling you, okay, we think we're going to be able to live with the virus. We don't know when vaccine will happen, but what we know is that investors are terrified and too defensively positioned, so they are not ready for any good news. That was the story of 2020. That's why you had to buy the dip. That's what we did in March. You had to buy the dip because everyone was underinvested and could only buy. The picture has changed. It has changed dramatically because now there is a consensual optimism. So we don't think that we will have this kind of huge acceleration that we could see last year. I told you a word on equity valuations. Why we are not that worried, that concerned by this 96% expensive percentile. The reason is that stock valuations are very expensive in absolute compared to history, sure, but they are not compared to interest rates. And it matters because asset classes are competing between each other in a portfolio. And let me illustrate that. The chart on the left, I will maybe spend 20 seconds on it. It compares interest rates. You can see the orange line is the interest rates on cash. The gray line is the interest rates on bonds. So on Sukuks, it's the same, slightly lower. You can see the cycles from the Fed, but overall we are super, super low. And it compares this with the equivalent for equities, the dark line. It is the earnings yield. What is that? It's very simple. When you buy 100 of equity, how much do you have in underlying profits? Because the profits are the basis for dividends and for your expected return. So currently, we pay 25 times profits, which means 4% earnings yield. And I compare these 3 things. So if you look at the dark line, yes, it is very low. 4% is a level that we had only seen before during the 2000 technology bubble. That's why many people say, hey, we are exactly in the same situation. But the difference, look at this 2000 period. Yes, equity yield was at 4%, but a conventional investor, they could get 7% from a fixed deposit or 6 to 8% from a very safe bond. At this time, it was crazy to go in stocks with lower expected return than much safer assets. This is a bubble. Now it's very different. You have no alternative. And as soon as interest rates remain low, we believe that they will remain low. There are many reasons for that. I'll come back to that as well. Equity valuation should remain high. It is not the kind of bubble that you had when the riskiest asset was more expensive than the safe. This is abnormal. It's not the case anymore. Second reason not to be too concerned is that, yes, currently we have seen a rally, retail speculation, markets are hot, but the long-term allocation of institutional investors to equities are just average. They shouldn't be average. These guys, they need return. Think pension fund. You need your return to pay the pensions at the end. So you won't find returns in the fixed income sphere. You have to go to equities. They are not overbought yet. So that's why we think valuations are okay. Second message, always a bit the same, I know, flexibility, because prepare for volatility. I just told you that we have elevated valuations. We also have optimistic sentiment, and we have plenty of risk. So you put all that together, you have a risk of seeing mini crashes all the time, and that's probably what we are living. You know, yesterday, the US stocks, then the Nasdaq lost 2.7% because of fears of interest rate. Markets are very sensitive. You will have volatilities. What about the risks? We have listed 5 risks, and I will just tell you a word about the first 2 because they are the most important. The first one, it's the COVID forever. What if vaccines don't work? We consider that there is a very low probability, and we monitor what happens, of course, in the Middle East, because this is where you have the 2 leading countries in the world for vaccinations, the UAE and Israel, of course, and we look at what happens there, and it looks encouraging. But still, if we have this issue of vaccine not working, new variants coming all the time, there is nowhere to hide except in gold. That's probably the only asset class that would react positively to such a nightmare scenario, because it is a nightmare. We don't believe in it, and we monitor it. Second risk, of course, the second probable risk is less policy support. What if this magic money suddenly stops? We don't believe it will happen, because the reason why it should happen first, it could be inflation. We believe in a temporary rise of inflation expectations, but still unemployment numbers are very low. Capacity utilizations are not that high. And you know, the drivers in place to support low prices, should it be demographics, technology, globalization, nothing has stopped. So we believe that fundamentally there is no room for a real spike in inflation. And second, it's very pragmatic. No government in the world can afford higher interest rates. They can't. My country, France, if you put the interest rates at 2%, it's bankrupt. Interest rates are at 0. And it's the case everywhere. And there is really, we believe that now this combination, it's like a wedding, you know, between fiscal policy and monetary policy is here to stay. I can give you 2 examples, which I think are striking. Who is heading the US budget now, the head of Treasury? It is Janet Yellen. She was the former head of the Fed, of the US Central Bank, and she was one of the most dovish, accommodative central bankers in history. Now she is on the budget side. Same in Italy. When the president asks someone to form a government for Italy, who is it? Mario Draghi, the former president of the European Central Bank. We believe it works together. So, sorry, I spent a lot of time. Prepare for volatility. It's not over, and we are ready to act. Third message, I know I sound like a broken record, but emerging markets are good, not just for the long term, but also for this year. They grow faster. They have been less affected by the crisis in 2020, and their rebound will be stronger. In China, think about it. They didn't even have a recession in 2020, plus 2% growth, because their recovery started in March. That's as simple as that. So they have a better backdrop. Second, valuation, they are cheaper. The chart that you can see in the middle, it's the discount between emerging to developed markets, in price to book value. Very briefly, in 2007, you might remember, for some of you, we were talking about the super cycle of emerging markets. They were very briefly more expensive than developed markets, but they are back to a very fat discount in terms of valuation. So they grow faster, they are cheaper, and last thing, they are less crowded. People in the US with their fiscal checks, they don't speculate on Chinese stocks, they speculate on their own, and more importantly, more generally, the weight of emerging regions in the economy is much higher than the weight of emerging regions in portfolios. And we believe that it's time to be rebalanced. So our recommended positioning, that's our tactical asset allocation. The strategic defines the profiles, and the tactical tell you where are the current opportunities for the year. No doubt, we are neutral on cash. The beauty of cash, it yields nothing. And to that extent now, Sharia compliant investors are in the same position that conventional investors. It yields nothing. And I think that Islamic finance was right. Maybe it shouldn't yield anything, but it cannot go down. And it offers flexibility. So we own some. We are underweight in the fixed income, and Sukuks in our context is fair because, as I told you, rates should not go lower. So we are cautious on that. And we are overweight in equities, both developed markets and emerging markets. We have fair values, and Anita will tell you our fair values for equities. Currently, we have upside potential to them. When we reach them, we won't hesitate to sell. Last year, we sold in February, we bought back in March. We'll be ready to do that. And I think it's really the key message. It is our recommended positioning today, but we are a small team, and we are doing this in a very thorough, insightful, structured way to be able to adapt to changing conditions, and they will adapt. Last thing, we are overweight on gold, which is currently the worst performing asset class of this year. It was the best last year. It is the worst this year, but still, from what it brings to a diversified portfolio is good because it doesn't work in full correlation with all the rest. And importantly, it is the asset that would function under the worst case scenario, and it is the currency that nobody can print. And we think that in this time of magic money, it has some virtues. Just to conclude, we are 3 years into our new asset allocation process. So, we are very transparent with you. We are not 200 years old Swiss bank or a Wall Street superstar. You don't take what we say for granted. So we have to report our performance and what we've done. Our aim is to protect your capital better than competitors when times are difficult. That's what happened in 2018. On the chart, we are in light orange, and the average competition, it's a Morningstar index, is in dark orange. So our aim is to protect better in difficult time. It happened in 2018. To be as good as them or not far when markets rally. That's what happened in 2019. We were a bit below our competition, but not that much. And in 2020, thanks God, we have done both. And the key message I want to tell you is that we are ready to adapt to changing conditions again. And that's it for me. Over to you, Mustafa. I'll find you back at the Q&A.
Thank you very much, Maurice. Very, very interesting outlook. I was fascinated by it. I think that you are, probably 50% optimistic and 50% pragmatic. A lot of adaptation and flexibility in managing, the volatility that's around. And I was truly fascinated by the broader perspective of things like MMT and the long-term impact that they may have on our markets. Ladies and gentlemen, with that, I think, with this context in mind, I think it's very, very good for us to do a straight deep dive into some of these asset classes. And it gives me great pleasure to introduce the next session, which will be around equity strategy. That will be delivered by Anita Gupta, who is the head of equity strategy at the CIO office at Emirates NBD. But as always, before we get into it, I would like to, again, get a perspective of the audience to see what they think with a poll question. And the next poll question, again, will be focused on equities. And it is around the focus between the UAE, which is obviously one of the leading markets within emerging markets that has performed, and the technology sector, which we saw do fantastically well last year. And really what we want to ask the audience is, if you had to choose, or if you had to focus on these, would you go completely aggressive on UAE stocks and the companies that are available at very compelling prices today? Would you go all in on technology, thinking that innovation is going to be the source of growth going forward? Or would you want to take both, right, and consider that both would be critical for the future? So this is the question. I know that there's, it's very difficult to narrow down the equity market into just a few areas, but I think we really want to understand, the faith in the local domestic market and stocks in that market. We want to understand, the faith in technology and innovation, and what the audience feels would be the appropriate strategy for them going forward from an equity perspective. And I think if we can go to the answers for that, it will be very interesting to see. I'm also quite fascinated to see what the audience thinks on this front. Very interesting. So 54% feel technology and innovation. Obviously, we know the impact and performance of the technology sector in the equity space last year. So that is not surprising. And then 44% consider both to be significant. So having faith in both the UAE markets and in technology, and only 2% considering a pure UAE strategy. And I think that's fair to say, because I don't think anyone can ignore the technology sector when it comes to equity investments nowadays. But I think context, Gupta. So Anita, I'd like to hand it over to you to run us through the equity strategy that we should be looking at in 2021.
Hi, so good morning, everybody, and thank you for that introduction. I see the UAE as synchronous with technology, because today in the UAE we have innovation, we have adaptation of digitization across both government and the private sector, whether it is DP World, whether it's drones and it's automation, whether it is setting up of an AI university with which is going to be seed investing and fostering new technology ventures. So let's say that both are synchronous. It's not one or the other, it's both for us. When we are talking about positioning for equity strategy now, and when we're looking at the decade ahead of us, the year ahead of us, and how do we position in markets that have been making record highs post the March sell-off? Of course, now in the last few weeks, we have seen volatility. So we have seen global equities led by the US in the last 5 years. US equities are up 100%, emerging market equities not far behind, and technology double of that. Our capital market model, which has been done in-house, estimates that emerging markets would return 8% and developed markets close to 6% for the next decade per annum. But when we see these new record highs, we see the future returns, and we ask ourselves, when will the music stop? Will it stop? Do we need a different tune? Is technology in a bubble? And we have new trends emerging, companies that we had never, really focused on, companies like Moderna or Novavax or, even BioNTech. Now, these are on the tip of everybody's tongue. You have new retail-induced, trading that from social media, whether it's Reddit or Wall Street Beats. So trends keep changing. However, what is important to remember is that we are now in a period of accelerated economic growth as economies open up, accelerated profit growth, and the returns that we estimate for the next decade, we are fairly optimistic about achieving those returns. And also remember that equities as an asset class have historically provided the best returns, and that is also forecast for the next decade. So to go into, our performance last year, we saw global equities gain 17%, yet corporate profits dropped 15%. China led, followed by the US. Emerging markets were in the lead. Looking at the sectors, again, technology led. Currently, we have, on the geographic side, much the same. We've got China and emerging markets leading in 2021. On the sector front, however, what we have leading are financials and materials and energy, and I will come to that. So we have drawn up a market health checklist as what are the catalysts post all the, the rise that we have seen in 2019 and 2020, and with stocks at elevated levels. And on the positive side, of course, is the earnings breadth, recovering consumer demand, very evident if you look at even the luxury sector in Europe. Companies such as LVMH have posted, strong results. Geopolitical issues, a lot of them have been sorted out. Of course, we come to the topic of the day, which is yields and inflation. Now, obviously, when you have higher yields, but what is the cause behind it? As long as it is growth and not, just, pure inflation, that's positive for equity markets. And of course, the worry is that, with increased stimulus, you could see inflation creeping up, but we are still, way, off the Fed target of over 2%. So it's still not a worry, and we would see, yields as more driven by growth. On the negative side, of course, you've still got unemployment close to 10% in the US, higher numbers in Europe. You're also seeing, local supply chains shift more domestic, so less of, globalization happening at this point. However, what's important is that earnings are the primary driver of equity performance. And that's what we need to watch, including all the factors around earnings. So how do we position? As Maurice said, we are overweight both developed and emerging markets at this point, with a stronger bias to emerging markets. When we look at the developed markets, we have a preference for the US. US, of course, we're going to see increased consumer demand driven by, the stimulus, higher, money flowing. The savings rate has gone up. And of course, the US is home to the world's most profitable technology, healthcare, and consumer companies. We also have more policy certainty now with the new Biden Democratic, government. On the emerging market front, we prefer Asia. I will come to why we prefer that a little later. And of course, emerging markets, lower valuations, higher growth story for the next decade. Our preference for positioning within sectors, we look at it in three ways. For growth, we continue to like technology and healthcare. We are seeing a rotation between, cyclical and growth strategies, and that's going to, continue with, obviously, technology, which has been the winner the last 2 years, now taking a little bit of a backseat. On the cyclical front, we have preferred financials from about the end of last year. Rising yields are very positive for bank profitability, and also banks are a barometer to global growth. For income, many healthcare and consumer companies will give you, a yield of over 3%. But our theme for the next decade remain the synergy between health and technology, overlaid by environmental, social, and governance factors across all investments. If you look at the chart in front of you on the dark blue line, that is the performance of our developed market sustainable portfolio. And that has outperformed global equities by 30%. Selecting companies with good balance sheets, high ROEs, and sustainable businesses definitely pays off. We're going to look at, very quickly at, what are fair values for the main global indices for the end of 2021. And again, as Maurice said, we have upside on all the main regions that we look at. Highest upside we expect is from emerging markets in China. And on the developed market side too, we expect returns, of almost, close to double digits from Europe and 8% for the US. We calculate the returns very simply, a multiple of forward price to earnings and EPS growth. Now, the PE multiples that we have are a little higher than the trend over the last 10 years, but it's justified by the high earnings. At the moment, the number that we have put for US earnings growth is around 21% and 30% for emerging markets. But we expect these numbers to be revised upwards. We have seen a very, much better than expected Q4 for earnings, both in emerging markets and the US. For the GCC, we have again got, upside predicated, though within the GCC, we have a preference for the UAE. So emerging markets, why our preference is just the start of a super cycle. Positioning is still light. If you look at the chart in front of you, we look at, earning multiples, we look at valuations, both are very favorable, high growth. The digitization of emerging markets is also leading to accessibility to a very large middle class in terms of consumer products. Besides China, which is way ahead on the digitization and e-commerce and internet use, you have a lot of other emerging markets, including India, which have still got room to catch up. So as we see this, consumer demand pick up, and we're going to see, that high earnings growth definitely come in at 30%. We are also seeing, emerging markets, especially countries like India, are now seeing less of the virus impact. They've been ahead on the vaccine rollout. Also, ultra loose monetary policy should continue for the time being. The emergence of a number of local, e-commerce companies also within emerging markets are now providing some strong competition to the Western incumbents like Amazon, whether it is Mercado Libre in Central America or Reliance Retail in India. We now come to the UAE, which is, of course, our preferred market within this region. What we are seeing in the UAE, if you look at those numbers at the bottom, total return, pretty good, much better than global equity returns, especially for Abu Dhabi, driven by telecom and banking sector. We stay very positive, the UAE, at this point, as we see the strong vaccine rollout, which will boost, tourism. Valuations are very attractive, at a price to book of 0.8, half that of emerging markets. Going to see, increased tourism from the Expo, 2020, which will be held this year. But mainly we have seen, a lot of reforms coming into the capital markets, foreign ownership limits being, increased across the banking and telecom sector. How do we mitigate the low trading volumes? And that, also leads to a question of, increased weight in the emerging market indices. And that should happen as, we see the FOL limits, improving the trading volume and increased international investor participation. On the UAE, we are overweight banking and telecom, the former driven by higher yields, telecom driven, of course, by increased work from home and streaming. And also logistics, but less so, of course, we focus more on, companies which are delivering the increase in e-commerce demand. Going on to, our themes now, which I will go into more detail. And of course, the pandemic has accelerated some of the, trends that were already in place, whether it was the higher use of e-commerce or, streaming or gaming. But we don't think that's a trend that's going to go away even, once the pandemic, effect dies down. And the three themes I'm going to talk about today are connectivity and a focus on the technology sector, the synergy between health and technology and preventative healthcare. And thirdly, overlaying all this is the environmental, social, and governance factors. And if you look at that chart on the left, it just, illustrates that the dark blue lines returns in 3 years and the orange line return in, 2020. This was already, themes which had been in place for the last 4 years. It's not new and it's not going away. Starting off with the technology sector, what lies ahead? Our biggest concern today is, regulations. And today, the technology sector is not just the, internet. It is basically the connection between your workplace, your mind, and then that raises, issues around data, because your health, wealth, metrics are now available to all big technology companies. The monopolistic, power that some of these larger companies have is now being monitored by governments. You've got social media, which has, become a big influencer, whether it is in trading with a huge number of users. So is technology in bubble territory. When you see the astronomical rise of some companies such as Tesla, you see Robinhood becoming a popular trading platform. You see IPOs which are launched, such as, the Ant Group, which are bigger than the, economies of a number of countries. So what are the trends that we think are going to last in technology? Technology today is at the heart of every industry. We are seeing, of course, increased global customer digital interactions, with the effect of the pandemic and, continued, learning from home and work from home. And what's important around this is the digital payment network, cybersecurity, and e-commerce is only going to grow. And it's not just the e-commerce growth, it is the logistics around e-commerce, the speed, quality, and flexibility of delivery. But surrounding all this, of course, is 5G, because 5G is important not only for your streaming or downloading, but today with the cloud and the infrastructure around the cloud, whether it's private or public cloud, that is made it much easier to use services. Data around health has become more important, easy to monitor both for countries, as well as private organizations, hospitals. And that leads us to, our last theme, which is, of course, which we focus on environmental and social factors, the proliferation of electric vehicles, which is only going to increase. Quarter of the world's fleet should be electric vehicles by 2030, as per estimates. We're continuously seeing innovation in that area. It's not only about, Tesla or Chinese companies. You have a number of European companies, Volkswagen, all spending money on innovating. Volkswagen budget is about $88 billion. But in EVs, we focus on the batteries. It is the weight of the battery, the cost of the battery, the life of the battery, and its pricing that remains important. Coming to our theme for the next decade, and that's a synergy between health and technology. And today, when you look at, returns and, you look at the global telehealth market size, which is increasing, you look at genomics, with vaccines being rolled out in 10 months. You look at telehealth today, if you look at, countries which are using Babylon services, providing access to people in remote areas. You look at, wearables. Governments are on a mission to spend, less on curing. The focus is on preventative healthcare, which is again where the synergy between technology and healthcare becomes even more important. Lastly, and to conclude, everything we do in investments has an overlay of the environment. Carbon emissions are very important, with many countries aiming to be carbon neutral by 2050. We also have many companies, water, clean water, climate change remain important. The transition to a circular economy. So to conclude, when you are investing for growth, we like emerging markets and the technology and healthcare sectors. We would overlay this with the themes of course, the synergy between healthcare and technology. So have a good day, and, back to you, Mustafa.
Thank you so much, Anita. That was truly fascinating and so many insights coming out of that. I am mindful of the time, otherwise I would love to dwell on that a little bit, but we have a lot more to come, so we will continue on. And with that, we would move to the next session of the day, which would be focused on fixed income strategy. And that session will be delivered by Satyajit Singh, who is the fixed income analyst at the CIO office. But as always, before we hand over to Satyajit, I think we would go into the poll questions. And the poll question, again, a very, very interesting one where everyone would have a particular opinion on it, is the 10-year US government bond yield is currently at 1.4%. From your perspective, is it ridiculously low given the level of global debt that we see? Is it reasonable because it is safe and at least it's not negative? Or is it attractive? Will central banks keep buying and it may drive all the way down to zero? So the question, 10-year US government bond yield, 1.4%, is it ridiculously low, reasonable, or attractive? And I think with that, we can move to the result. Very interesting. Some people consider it to be very, very low, given the levels of global debt, 55%. The rest of us think that it is reasonable, and at least it's not negative. Nobody considers it to be attractive. And I think that's not surprising, given that we want to maximize our returns. But very, very interesting insights. With that, Satyajit, I'll hand it over to you, and you can run us through the fixed income strategy that we should be considering.
Thank you, Mustafa. Good afternoon, everyone. Welcome to the fixed income part of the session. Very interesting results of the poll, but we'll reveal our views in the middle of the presentation. So So we'll focus on our positioning, strategy, and try to answer the million-dollar question, how to protect your portfolios during the taper or taperless tantrums that we are seeing now. The starting point, as you can see on your screen, there has been a fast and massive spread compression from March 2020, driven by monetary policy support. What that has meant for various subsectors is that most of the spreads are trading below their historical medians and very close to 2018 lows. That means low rates plus low spreads translates to low returns for the fixed income asset class. Our aim throughout this presentation is to present you opportunities to navigate this scenario and to generate decent returns in 2021. So where do we go from here? We advise you to get comfortable with risk. What does that mean? That means the safe haven asset classes, such as the treasury bonds, the IG grade credit, they would give you low to negative kind of returns. We have seen that at YTD already. And that also means that riskier asset classes like high yield and emerging market debt should consider a chunk of our portfolio, because that's where you would get the maximum coupons and the maximum capital appreciation possibility. What about our regional debt, GCC debt? It's a very fascinating asset class because in 2019, it actually topped the returns chart. And in 2020, it actually finished second within fixed income subsectors. But that means most of the low-hanging fruits have been taken out of the equation. And are there pockets of opportunity? We think so. And when we do a deep dive, we'll definitely go into that. But let's come back to the poll question. At the start of this year, we estimated 10-year treasury yields to end the year at 1.2%. But also we noticed that there is an upside risk, especially of the treasury yields hitting 1.5 or 1.6% somewhere in Q1 or Q2. And that's what has unfolded. Going from here, we think majority of the yield uptick is behind us. It should be more range bound now. Now, starting the deep dive with the developed market government bonds, we think they do not mitigate risks to your portfolio well enough as they did in the past. Why? Look at the low yields and combine that with Fed's unwillingness to go into negative rates territory, because that's harmful to the large banks which are based out of the US. What that means is that if the next stress appears on the horizon, the yields cannot move lower, a lot lower from these levels, and they will be stuck. And that means the capital appreciation that you used to get from the developed market bonds when stress periods used to hit the economies will completely be absent the next time. What that also means that if you have any long duration bonds on your portfolio and the current yield uptake, which is continuing, goes any further, you will have a large loss on your fixed income asset portfolio. That's why another advice is basically to eschew any kind of long duration portfolio exposure and specifically go into bonds and sukuks, which are less than 10-year-old in terms of that duration. What about IG credit? You can see the massive spread compression again that has happened between June 2020 and Jan 2021. But what that means is that BBB rated entities, which actually used to drive the majority of the returns from this asset class, are trading between 1.2 to 1.3% kind of yield. That means basically is that any slight uptick in the yields, 10-year treasury yields or the 30-year treasury yields like we saw in the past couple of weeks, will wipe out years of returns from this asset class. And that's why we are underweight this asset class. High yield is a preferred asset class, and we think that should provide you the highest capital appreciation. Why? Fundamentally, if you look at the default rates, after peaking in Q2 2020, they have come down significantly. Why this has happened? Because of the opening up of funding markets. We had seen a record number of primary issuance from high yield last year. And this year, the numbers YTD are 35% up compared to last year. What that means is that most of the B and BB rated entities, they have enough cash to tide over any short-term uncertainties that might come out. And that should keep the default rate at whatever levels it is now. We are very proud to say that we cover close to 500 bonds and sukuks single line securities. But even though the default rates have doubled to 5.5%, as compared to the historical levels, we had zero default. Some of them say we dodged a bullet. I would say we dodged a bazooka. And going forward, we have kept increased surveillance on the list of bonds and sukuks we have. And I intend to keep that record as it is. Coming to emerging market debt, we think selectivity remains key here. And why is that again? If you look at the left side chart, you can see that the spreads in emerging market debt on an average are trading below 300. That means the 12-month forward average returns should be somewhere between 3.3% to 3.5%. But remember, emerging market debt is not a homogeneous asset class. It has regional and rating dispersions. So what do we like? We love Asian high yield because it stands out in terms of duration adjusted returns. What does that mean? On the x-axis, we have plotted duration, which basically measures the sensitivity of price change to yields increasing. And on the left side, we have returns plotted as yield to worst. And you can see that Asian high yield actually stands out compared to its peers in terms of attractiveness. It has low sensitivity to increase in yields, and it provides an outsized return. And that's why we continue to like it. Now, coming to our regional markets, MENA debt, as we told, that most of the low-hanging fruits have been taken out of the equation. But are there opportunities? There are three sub-asset classes that I would like to go into. First, if you're constrained by your mandate to invest only in IG, investment grade credits, then I suggest you to go into sovereign-owned entities that are trading at least 15 to 20 bps wider to the underlying sovereign curves. And there you get a yield uptick. Plus, because of the low rates, low leverage cost, you can safely lever them and get that additional yield that you are looking for. Coming to high yield, we prefer Oman and Egypt compared to Bahrain because of the higher and juicier yields that it provides. But here positioning remains key. We prefer the 7 to 12-year part of the curve, both of these sovereigns. If you go to the left of 7 years, the yields are very low and uninteresting for our investors. If you go to the right of 12 years, then the curve becomes really flat. And what does that mean? Is basically you are not being compensated for the additional risk in terms of duration you are taking with any kind of yield uptick. The third and last pocket of opportunity here is basically subordinated bank debt, especially the 81 perpetuals that have been issued by DIB Sukuk or the tier 2s that have been issued by Riyadh Bank. They present very specific and interesting opportunities because relative value-wise, if you compare subordinated spread to senior spread, the higher that number is, the better returns you are getting for the risk. And the champions banks of the GCC are actually giving an outsized return as compared to a globally renowned benchmark such as iTraxx index. Now that we have covered conventional asset class, let's focus on sukuks. It's at a very challenging and interesting juncture, I would say. Why? Because of the yield distribution. 80% of the sukuks actually yield less than 3%. In June 2020, when we did the mid-year outlook, this number was below 50%. That means more and more sukuks are yielding lower. And on the right side, the complication ensures because 50% of these sukuks actually mature between 2022 and 2025. What that means is that if you chase high yield and go into sukuks, which give 6%, 7% kind of returns without any leverage, they would have been issued by very, very risky issuers. And when yields actually go up from these levels in 24, 25, those issuers will find it very challenging to actually refinance these sukuks. So that's a key risk about chasing yield in sukuks. So how do you play sukuks? Because our focus is on dollar and euro denominated sukuks, most of them are issued by MENA entities, MENA-based sukuks issuers. And that means you basically replicate whatever the three paradigms I told you about the MENA bond market, and you can play it exactly like that in the sukuk market, and you should be good. Now, the last slide, as I promised, we'll focus on the million-dollar question, how to protect your portfolio. First of all, this is a taperless tantrum. We think markets are running ahead of themselves, and Fed will continue to hammer 3 points. First, if you focus on any of the speeches of Chairman Powell, he has been constantly saying that they will look through any transient uptick in inflation. Why is that? That's the second point. They will not raise rates until we see a full and inclusive employment in the US. Current unemployment numbers are around 10%. Unless they go to around 4% levels, we don't think that rates should rise, because without employment, inflation is not sustainable. Third is the most important part, where the Fed will continue to hammer that any discussions about tapering of asset purchases is premature. So that's why we think the yields are running ahead of themselves by pricing in any rate hikes which are there in 2023. With the Fed dot plots themselves do not predict any rate hikes till the end of 2023, right? Now, how do you protect your fixed income assets during such an increasing yield scenario? Again, three methods to do that. First, it's a cliche, but diversity or diversification remains your key friend, especially into cyclical sector stocks like financials, industrial. They should do well when the growth happens in the economies. Second, our preferred asset class, high yield and emerging market debt, have a very strong spread headroom, and they can compress and give you the capital appreciation. For an example, between November 2020 and February 2021, 10-year treasury yields actually increased by almost 50 bips. But if you compare emerging market debt and high yield, they actually came down by 60 bips and 70 bips respectively, giving a good capital appreciation. And that's what will happen going forward as well. Third is basically for our qualified investors who can take position in some structured products, where the structured products actually give you benefit when rates or yields go up, and they protect downside if yields go down. So these are the ways in which you protect your portfolio when rates actually and yields go to and increase considerably. That's all from my side. See you in the Q&A session. Over to you, Mustafa.
Thank you so much, Satyajit. And I really liked what you said. Start to get comfortable with risk as a key way to navigate through fixed income. Ladies and gentlemen, with that, we will come to the next session of the webinar, which is going to be delivered by Khadija Haq, who is the head of research and chief economist at Emirates NBD. And that's going to focus on the economic outlook. On the economic outlook, and both globally and locally, and the key trends that we need to be mindful of. So with that, Khadija, over to you, and take us through the session. Thank you.
Thank you very much. There's not a lot of time left, so I'm going to try and push on. Maurice has already spoken extensively about our views on low interest rates for a long time and extensive fiscal stimulus, which will support global growth. Now, one benefit of that for the region, which we will definitely enjoy, I think, hopefully in the next year or so, is dollar weakness. Now, particularly the services sectors in the region, if we look at Dubai's tourism, for example, have struggled with eroded competitiveness because of a stronger dollar over the last 3 or 4 years heading into the pandemic. What we've seen now is a weakness in the dollar in 2020, and that is likely to continue into 2021, which would help to restore competitiveness in those services sectors in particular, given that we have a pegged currency. This will hopefully support growth, as will low interest rates in the US, which obviously translate into low interest rates in the region as well. The outlook for oil remains fairly balanced in our view. We've seen a strong rally at the start of the year, but that has been largely due to things like bad weather in the United States, which has temporarily weighed on US production. Going forward, though, OPEC is very likely to increase production, and we will have to still see how the demand for oil globally evolves from the second quarter onwards. So at this stage, we're still holding on to our $50 average for 2021 on Brent. Obviously, after today's OPEC meeting and the production changes that are announced, we may have to revise that view going forward. But overall, we don't expect OPEC to fully bring back all of the production that they cut in 2020. And so as a result, we think the oil sectors in the UAE especially is still going to be a headwind to recovery in 2021. So we're not expecting an expansion in the hydrocarbon economy. If we look at the non-oil sector, we clearly saw a significant contraction in 2020, and I'll go into the key sectors in a few minutes. But the outlook for 2021 is much better. So we are expecting the non-oil sector to rebound by around 3.5% this year. And that, again, is going to be driven by a rebound in global GDP, as well as hopefully a pickup in travel and tourism, an improvement in logistics and global trade, particularly in the second half of the year. Now, the survey data that we've seen for Q4 and January and February as well show that growth in the UAE and even in other GCC countries has actually been quite slow in the first 2 months of the year. And to a large extent, that is because of quite a lot of uncertainty on the part of businesses about how long the pandemic impact will remain in place, how long global restrictions on travel and movement will remain in place. And that is also weighing on businesses' willingness to borrow. So we look at credit growth for the private sector in the UAE, and we see that that is actually contracted from the second quarter of 2020, and it hasn't gone back into positive territory yet. So that tells us that there's not a huge appetite to borrow from private sector companies. And to some extent, that is going to weigh on investment. It's going to weigh on their desire to boost hiring. And the employment issue is a big one for the UAE because obviously such a huge share of the population is expatriate and employed in the private sector. So when you see the kind of job losses that we saw last year, that then has a second round impact on the overall size of the population, which then has an impact on how much consumption will recover when restrictions are lifted and activity normalizes. So it is quite important that we start to see businesses going out and hiring again to try and provide that confidence to consumers as well, that the outlook for them in terms of employment and salaries is looking a bit better, and hopefully that helps to boost consumption. So overall, really the driver for recovery in the UAE and the wider region, in our view, is really going to be an improving external story. It's not going to be driven by domestic internal dynamics because we just haven't had the same kind of direct fiscal stimulus to households and businesses in the region as we have seen in other big economies around the world. In terms of specific sectors, you can see, from the GDP data for Dubai in the second quarter, hotels, restaurants, transport, storage were all significantly affected by the border closures in the second quarter of last year. Wholesale and retail trade also obviously affected by households spending less and stores not being able to open fully. We did see manufacturing hold on quite well and actually show a little bit of growth, which is encouraging because it suggests that that sector will continue to benefit as economies around the world reopen. There are opportunities for UAE manufacturing to grow as well. When we look at the hospitality sector, we can see that December was a very, very strong month, even though obviously the rest of the year was a little bit of a write-off. And that's encouraging because it tells us that when people are able to travel, they will. And so I think as soon as we start to see the travel restrictions in Europe lifted, we should then start to see a return of visitors to the UAE and Dubai in particular. And so we're expecting that to improve in the second half of the year. And obviously with Expo in Q4, that should attract a greater number of visitors as well. And then finally, to touch on the real estate sector, because obviously I'm sure that there's a huge amount of investment already in that sphere. We have seen prices continue to decline in the secondary market, but the rate of decline has slowed. And what was interesting in the fourth quarter is we were starting to see a difference between different types of real estate in terms of how they were faring on prices. So there was an increased demand for larger units, for villas. And so we actually saw villa prices on a quarterly basis rise in Q4 in the secondary market for the first time since, I think, 2016. Now, I'm not saying that this is the bottom, but I think we are starting to see quite solid demand for existing units, and that's reflected in the transactions data as well. So when you look at the recovery in the volume of transactions for real estate sales, it's really been driven by sales of existing property. We've not seen the same kind of growth in off-sale property, which again, it makes sense given the pandemic last year and the dearth of new projects being launched. But it does suggest that there is quite a lot of discrimination on buyers' side. They are willing to pay up for bigger units, for more space, particularly with working from home. And so, we may start to see a bigger differentiation as well going forward. I do think also that the changes to the borrowing requirements last year helped to boost demand for real estate in the UAE, because borrowers were able to take out a little bit more on loans to allow them to buy property in the secondary market. So I'm going to leave it there because we are short on time and it would be good to take some questions.
Thank you so much, Khadija, for that update, particularly around the UAE, which I think was definitely on the minds of many of the attendees that are attending the session today. So with that, ladies and gentlemen, we come to the final presenter for our session, and that is Mr. Syed Umair, who is the head of Private Banking and Wealth Management at Emirates Islamic, and he will be talking about the wealth management proposition in Emirates Islamic. So without further ado, Syed, I'll hand it over to yourself.
Thank you, Mustafa. Thank you, everyone. So firstly, I would like to thank all the attendees for this webinar and to all the presenters so far, Mustafa, Maurice, Anita, Satya, and Khadija. The whole objective of these sessions is really that we share insights and be closer to our customers and really share what we as an organization at a group level are seeing the outlook for the coming year and the broader long-term horizon, and then how we can help as an institution with our wealth management offering to position your wealth investments accordingly and adjust them with this offering. So really, I think at Emirates Islamic, our focus in wealth management is really to be able to understand the specific needs of each specific customer and investor, and accordingly tailor based on the sessions or the details Maurice, Anita, and Satya have provided, and drill that down to each specific individual portfolio. And lastly, to complement that with truly innovative Sharia compliant investment solutions to our clients. So this is our endeavoring strategy. It's a journey we've been going through over the last 7-8 years to really bring value to our Sharia compliant investors and combine that value with the best-in-class offering and insight and research, which is provided by our CIO team, Maurice, Anita, Satya, and Khadija. So really, that's all I wanted to share with you, and I really hope that this session was insightful for all of you. And we look forward to having much more of these interactions during the course of this year, as and when we navigate the challenging times, as Maurice had highlighted, during the course of 2021 and further. Thank you very much, everyone, and I'll hand it back to you, Mustafa.
Thank you so much, Syed Umair. And, I just want to reiterate that this, I've attended many of these investment outlook sessions, and this has been one of the most insightful. So, all credit to Maurice and the team in the CIO office and Emirates Islamic for making these types of interactive opportunities available for their potential clients and investors. I am very mindful of the time. I think we only have about 10 minutes left, but I would like to go into the questions, and we've been getting a lot of questions from the audience, and a lot of them have been answered as we go through the course of the discussion, right? So people have been asking questions around, asset classes such as gold, which I think, Maurice, you covered in a lot of detail in your session. People have been asking, what is our perspective on the low interest rates and how long they will remain low, which I think we went into a lot of detail on. But one question that I'm sure, all of you could have guessed would be asked today, and I think I'll hand it to you, Maurice, to answer, is what is your perspective or insights on cryptocurrencies? And, how should investors be looking at cryptocurrencies, Bitcoins, and others when they're looking at their overall investment portfolio? So, Maurice, if you would like to tackle that, I'm sure everyone would love to hear your perspective on this.
Thank you, Mustafa, and thank you for the question. But I'm afraid I will disappoint many people because, we are very honest. we are not, we don't have enough insight to put the cryptocurrencies and crypto assets in general in our asset allocation today. It doesn't mean that we are not believers in that, because first, currencies are going digital, there's no question. Even fiat currencies, I mean, the renminbi will go digital. One day, the digital dollar, paper, will disappear. And there is certainly in this world of central banks printing money like they want, you know, there is certainly a need for something that is not centralized. Having said that, as an investment object, Bitcoin is currently a speculation object. And I must say that we don't do speculation, we don't know. So as an investment object, it's either a currency or a store of value. As a currency, currently, it's too volatile. It will be less volatile with more adoption. It's coming. You've seen Tesla buying Bitcoin, you know, this kind of thing. Currently, imagine if your salary is in Bitcoin. 2 years ago, 1 Bitcoin per month, maybe 10,000 dirhams. Now it will be 200,000 dirhams. It's quite a raise. You see, it doesn't work yet as a currency. And then as a store of value, frankly, we are very conventional. We use gold for that because Bitcoin could be a store of value. I personally believe that one day it could be at $1 million, but I don't know when. And I don't know if it will go at 1,000 before going to 1 million. So if Bitcoin is worth $50,000, I think gold should be worth more than 1,700, because you can use gold as an alternative currency that no central bank can print in the world.
No, I completely agree with your sentiments, Maurice. I think all of us suffer from, you know, what I like to call Bitcoin remorse, you know, having, you know, potentially some of us missed that opportunity. And, you know, the very fortunate ones who took advantage of that, I'm sure are smiling right now. But when you look at long-term wealth preservation, when you look at growing your portfolio, you know, it is too volatile and doesn't have the underlying fundamentals right now. Thanks for that. Another question, I think, again, Maurice, this is directed to yourself, is around the role of sustainability in an investment portfolio, right? So, you know, there's a lot of talk about ESG and sustainable finance today. You know, how significant is sustainability, you know, when investors are looking to build their portfolios for long-term wealth preservation?
Well, there's absolutely no doubt that sustainability is extremely important. And let me tell you what we do in the field. We do that forever, because the way we pick companies and issuers are, of course, with a huge quality bias. We do wealth management. We are not speculating. We are not a hedge fund in special situation. The point is that we don't formalize, we haven't formalized yet our policy, our ESG policy, and we're working on it, but we're working on it in a holistic way, because we think it's not just about, you know, putting 3 products about renewable energy and electric vehicle or whatever. It's about really thinking what makes a business sustainable. It's a business that doesn't borrow from the future and that doesn't extract outside returns from its stakeholders, you know, employees, suppliers, the entire society, and of course the environment. So we are working hard on a formalization of our policy, but we do that for long. Anita's recommended list of securities includes this criteria. There is no company that harms the environment or have, I don't know, children working in a remote place in China. That's not what we do. We have to formalize more. It's absolutely aligned with wealth management. You know, it's from a last word on that, because I was running sustainable funds back in 2004, so that's something close to my heart. You know, every investment has a horizon, and when we do wealth management, it's often from one generation to the other. So it means, of course, you want return. You want your grandchildren to inherit some wealth, but you don't want them to inherit your wealth in a devastated world. So you also take care about the impact of your investment on the world, because you protect yourself in the future.
No, that sounds that sounds very, very sensible. And just sticking to that point about future generations, we did have a question that came in that asked, how long can governments continue to increase their level of debt, and how long can central banks continue to, you know, as we say, print the magic money that they are currently doing, right? We have the example of Japan, but, you know, if we look at it, you know, about future generations, right? If we're talking very, very long term, you know, 50 years, 60 years, 100 years down the line, right? Is this going to be an economic policy that will continue to survive, or will there be unexpected consequences?
Maybe I can tell you what I think, but I'm sure Khatija would have more interesting insight. For me, we live at this time where governments consider that debt doesn't matter. Well, they had no choice, we have to say. Frankly, they didn't go that route by a decision. It was the pandemic was here. You had no choice. You had to avoid misery because that was the risk. So I'm not blaming anyone, but it happens at a time where at the same time you have disruption everywhere. And I'm thinking about automation, which is something that we have a bit forgotten. The fact that machines are going to be able to do the job of many humans. And it also changes the relation. Will there be jobs for everyone in 100 years? And if machines are doing it, what is the role of a government? Maybe it's to give money to people to survive while machines are working. I think we live in a fascinating time, and it's difficult to consider debt as we used to, probably. But for me, I'm worried by that. And I prefer the wisdom of countries like the UAE, for example, who are much, 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 much more reasonable in terms of debt and of others. And I think there is by the way, we were just talking about sustainability, and we are in an Islamic finance context. I think that there is a huge convergence between what is sustainable and the principle of Islamic finance. It's about you don't get returns without risk, you don't do speculation, and excessive debt is bad. I believe in these principles, but 100 years down the road, will we be working? I don't even know.
That's fascinating. And Khadija, we'd love to hear your perspective on the same point and on the same question.
I'd like to add a couple of points. Yeah, so there are two things I want to flag. One is that growth will erode the value of the debt. So as economies grow, the stock of government's debt becomes much more manageable and much more easy to not overlook, but at least it's sustainable if the economy is growing. The other issue I want to raise is one which is linked to inflation, which ultimately drives policy rates. Technology is deflationary by its nature. And so, I think, yes, we will see inflation rise over the next 6 to 12 months because oil prices are coming off a low base. There were supply disruptions last year for the pandemic. There's low rates. So all of these things, you've got obviously consumption, which is going to pick up very strongly. So that will boost prices. But that's not likely to be sustained year after year after year. Technology, brings down the cost of doing things. A lot of low-cost labor. There is a lot of excess capacity in the world, which will help to keep inflation contained. So for those reasons, we don't believe that interest rates are going to ratchet up in the next 6 or 12 months. We think, the Fed and other central banks as well will look through any increase in inflation as temporary. They're looking at 2022 and 2023 inflation when they're thinking about their policy decisions. And we firmly believe at this stage, based on what we've seen over the last 10 years, there's no reason to believe that underlying inflation will remain sustainably high going forward that would warrant aggressive monetary policy tightening in the next.
That sounds very good. I'm mindful of the time and the questions that are coming in. This next question, I think I'll direct to Anita. And this is basically asking questions around ETFs and, how significant is ETFs. And I think just to add from my side, we've constantly been talking about being selective, right? Being agile, being selective in selecting the investments that we do. So how does that tally with an investor who may be looking to invest in something as broad as an ETF in a market?
Yeah, so whether you invest in securities or funds or ETFs, it is the overlying investment strategy that will drive the returns. So currently, at the bank, we are, agnostic between the three. What really works is, active management and also looking at those trends which will give you the returns over the long term. So we identify the trends. Now, whether that investment bucket would then be filled with single line securities, stocks, or whether it would be filled with funds or with, ETFs. So while, funds are actively managed and they provide, returns because you have a lot of very good fund managers, At the same time, there's been a strong development of the ETF industry because there are some niche areas, very specifically, whether, it is, genomics, or whether it is, robotics, or, whether, electric vehicles, which makes it easier for some investors to come in, rather than, just look at the larger actively managed funds. So yes, ETFs will give you that platform to go into the smaller niche areas. But again, I would say the focus would be on what is your investment strategy.
No, I think that makes perfect sense. And exactly, strategy is critical to any investor's portfolio. I know that we've run over time by 10 minutes. We have had a lot of comments, positive. I think I'll hand the last word over to Sayyid Umair. We've had a lot of positive comments regarding the webinar coming in through the Q&A, and a particular individual who is asking, why don't we have these briefings on a quarterly basis, which is very, very heartening to hear. But Sayyid Umair, I'll hand it over to you to give us the last word and to conclude the webinar, please.
So I think definitely we do this once a year, and we've been doing it for many years now. So I think for the last 6-7 years, we've had similar sessions. During COVID times, we moved it to a webinar format. But over the last 5 years, we would have the same similar style fashion presentation or session with our clients, both in Dubai and in Abu Dhabi. Now, I think what our learning has been during the course of last year is that we need to be much more agile and be able to share such information on a more dynamic basis with our clients. So I think what we've decided to do since last year is we've started to build out a quarterly investment outlook, which we share with our clients with the help of Maurice and the team, which is more of a booklet format, which shares our outlook and what has changed radically over the course of the last quarter and our outlook for the coming quarter. And what we'll continue to do during the course of this year is maybe not potentially have it quarterly, but have a mid-year version sometime in June, July, to see how things have evolved. What have we said from the beginning of the year and what we need to adjust to accordingly, and then do more deep dive sessions during the course of the year. So definitely it's a feedback well taken. We really appreciate the feedback that this session has been quite informative to our clients. And we look at how we do more of similar style sessions or more deep dive sessions during the course of 2021.
Thank you very much, Sayyid Umair. Looking forward to these future sessions. Ladies and gentlemen, with that, our time is up. I would like to take this opportunity to thank all our speakers, Wasim, Maurice, Anita, Satyajit, Khadija, and Sayyid Umair. And I'd like to thank you all for joining us today. And we hope that the session was insightful, and we hope that you will join us in future sessions. Till then, we hope that you and your loved ones stay safe. Thank you very much. Assalamu alaikum, and inshallah see you soon.